Good afternoon and welcome to Charting Points, a technical look at agriculture markets. Today is September 24th, and let's get into it. So first of all, we're going to read a little bit of a disclaimer here. Trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. The material is provided as is and for informational purposes only. It is not intended to be a substitute for specific financial, trading, legal, or tax advice. Neither Farmers Business Network nor any of its affiliates make any representations or warranties, express or implied, as to the accuracy or completeness of the statements or any information contained in the material, and any liability, therefore, is expressly disclaimed. Past results are not necessarily indicative of future results. All right, let's get into today. I think I just kind of amalgamated a bunch of charts that I thought were interesting. We're going to focus a little bit on two of the major crops here after the Statistics Canada report out today. That's canola and wheat. Didn't think I had enough time in this afternoon to get into some of the smaller crops. We'll maybe touch on those on our weekly report, which is going to be due out tomorrow, and in future videos as well. So we're just going to kind of go through this to kind of keep it succinct and get you on your way for the day. So here's the new Canadian canola production number, 17.368 million tons. That is a drop of almost 1.3 million tons year over year and was below industry estimates coming into the report. What that means is that canola yield currently is pegged at 38.2 bushels per acre. 2021 was reported at 36.4 now, which was recently updated at the end of August. So we're pretty down close to those levels, according to Statistics Canada. Now, anecdotally, I've been hearing better than expected yields in many areas, and I think the market is leaning towards the fact that the USDA may have underreported both production and yield in this report. You can kind of see that in the futures response today, which was positive, but not as positive as it could have been. We'll get into that in a second as well. And so that leaves us with, again, 17.4 million ton production number, which is what we get to put in our S&Ds, unless we want to go out there and claim that we know differently than the USDA, which I think the Statistics Canada, which I think a lot of people are, but I don't think you'll see it printed in a lot of S&Ds. We'll probably just see it worked outside of or into the demand side of the balance sheet, which is a pretty easy calculation to make. We'll talk about that in a second as well. Here's Canadian wheat production, which was reported at 25.7. This was a raise from the previous estimate, but was below analyst expectations. Just kind of looking a little bit more at what the whole picture looks like for the year now. Compared to last year, total supplies for wheat have dropped from 31.7 to 28.9. Let's call it 29 to be fair. That's 2.7 million ton reduction. And that will create some tightness in the Canadian wheat situation. However, I think just to kind of boil it down to the prairies, because there is some of that wheat is grown in Ontario year over year in Western Canada, we're looking at a difference between 25.3 million last year and 22.2. I'm rounding here. This year. So I had to do that calculation because I had forgotten to do so ahead of time. That is a 3.1 million ton reduction in just spring wheat in the three prairie provinces of Alberta, Saskatchewan, Manitoba. So that is a relatively bullish outlook particularly for prairie basis in spring wheat in Canada. And I don't necessarily think it will mean much on the future side, although it does have the opportunity to kind of keep Minneapolis futures elevated rather relative to some of the others, just based on that fundamental. But the U.S. will have a play in that as well. Just kind of wanted to break it down between the prairie provinces. So I would say it's about equal as to the reduction in Saskatchewan and Alberta. Manitoba on this chart is the green. There is some reduction year over year in Manitoba spring wheat production, but the major cuts were in Alberta and Saskatchewan. And from a percentage standpoint, each of those probably saw equal amount of losses. All right, I'm kind of jumping around a little bit here because I think when I pulled some futures charts, I kind of wanted to look at some that were maybe more on the interesting side, or just some charts that were overall interesting. So I kind of left out any charts that hadn't been, bouncing off any critical support or making new highs or new lows or anything like that. So, and canola may not fall into that category, but I did notice that yesterday's trade kind of hammered down to a new low just above 740, and it did rebound today. We closed relatively in the middle of the trading range today. It's around 758. I don't know if that is the settle or not. I might have pulled that before the price settled, but that'd be pretty close to accurate anyway. So I mean, some of us may be thinking, is this the bottom for canola? Are we going to see a bounce now? You can see that it did kind of test the 100-day moving average and may bounce from here. Today's Statistics Canada report is, on the surface should be bullish. I think the seasonal patterns as well should suggest that as we move towards October, we'll see better pricing in canola. And there are some fundamentals that also would support that as well. There are some concerns, though. One of them is the forward curve. And just to kind of simplify this, the forward curve, when prices are lower for nearby delivery and are higher for further out delivery, that is called a carry market or a contango market. What that signals is that there is the market is trying to build in an incentive not to sell today and to sell later out. And so they're paying you to do that. They're essentially paying you to store canola. Now, counterintuitively, this is a bit of a bearish signal. What you want to see in a bullish market is for the shortness in supply to be acute. And so therefore what happens sometimes is the front month or the closer months rally or are higher than the forward months. That signals a bit more of a bullish market because there is value in owning the canola now as opposed to paying somebody else to store it on their own property. And this is evidenced in not only the futures markets. Sometimes you'll see a carry in the futures markets, but it's not as big in the cash markets. I wanted to illustrate a couple of popular areas here, particularly the Yellowhead corridor of Alberta and Saskatchewan, where there's a number of crush plants. I think that's the major demand driver this year. And we even see cash markets in a carry or in a contango market as we move forward as well. So this is a bit of a bearish input. I don't think that the forward curve is going to remain this way. I believe that we are seeing this because of harvest pressure. I think that the system is being I wouldn't say overrun, but there is some pressure from the farm gate to deliver or to sell canola. And it's probably more of a farm gate push to sell canola into the nearby months. So as you can see here into October, November, which does a couple of things. It frees up some bin space. It might generate some cash. And these are probably bushels that were extra bushels anyway, as yields are kind of coming in from what I understand a little bit higher than expectations. So these, there is some extra bushels being marketed at this time, or at least some bushels getting marketed that are that weren't necessarily put into the minds of the market earlier when the dryness concerns were at their peak. On the flip side, on the bullish side, the reduction in futures values in canola is raising the canola board crush margin. This is January board crush margin. You can see it's kind of getting up to areas that we haven't seen these kind of highs in the last 6 months. I think what this will do is you'll see commercial crushers start hedging this margin, and then they're going to start buying into the physical. I think this is what will create the turnaround to some degree. The crush market continues to have much better margin structures in it than the export market. And so the push will be to go to the crush market. And whenever you see crush margins expand, I think there will be some hedging involved there. And once we get into areas of new highs, so particularly if these haven't been seen in the last 6 months, traders on the crush desks are likely to take advantage of this and lock up some business. So I do think that this is one of those signals that it is, again, it's the reason this is happening is because of reduced futures values. But once they get the business on the books and they have to go source the physical commodity in order to crush it, that's when I think we probably see some potential turnaround in this canola market. We did have a positive day on Euronext today, up almost 3%. I did want to check because this is the November contract, and we are at the time when the November rolls off as the front month contract, and the February would become the front month at that point. The November is still showing the highest open interest, so I do believe that this is, the most pertinent contract. It did kind of punch back above, this previous August low that it kind of broke down over the last couple of days. Is that a bottoming signal? I don't know. I'd like to see it kind of come up and move above some of these moving averages, but overall, I think the harvest pressure may starting to abate in the Eurozone area, and that may be forming some kind of futures bottom in that market as well. On one market that I found on the grain side that I found interesting today was oats. On the December really collapsed today, blowing below previous lows and below the 20-day moving average. I think there could be a correction in the offering here. It had been hovering around $5 for quite some time. It closed significantly lower, around $4.79 today. So I would look at that as a bit of a bearish signal here. If you're holding off on oats, or if our last recommendation wasn't made that long ago, if you did not take action on that recommendation, I think this is another canary in the coal mine that things aren't necessarily just going to go in one direction for a very long period of time. We've seen cash prices advance significantly as well in the last couple of weeks. So make sure that you're up to sales recommendations, and you're not going to let this slide by. A couple of other charts that aren't necessarily ag related that I want to talk about. West Texas Intermediate crude oil reached a new high today, above $90 a barrel. Shortness in supply looking forward as Saudi continues to keep their cuts on the table. The price of fuel is rising. This is also creating an upward trending market in heating oil, which is where diesel is hedged as well. So the fuel prices for everything from transportation to farming is experiencing higher costs as a result of this as well. This is driving some inflationary pressures, and it looks like, let's see, I did not include a US dollar index chart, but it made a new high as well today. Conversely, actually, you know what, let's see, I'm going to try and show you that because I think it's important here. So hang with me here. I'm just going to go and pull a US dollar chart because I did really want to show that. And so the US dollar index, rocketed higher above to new highs. I can't walk and chew gum at the same time here. So let's do one thing at a time here. Okay. Here we go. Here's our US dollar index. So here it made a new high today, 105.40 roughly. This is on some fears of increased inflation. So I think the market is still very sensitive to price fluctuations on high consumables, which would, fuel would be one of those things. Food would be one of those things. And so when we see the price of fuel go up, the expectation of inflation continues to go up, and then we start to see a run to the US dollar, not only because yields are increasing, but also as a flight to safety, because it does put risk into some of the other markets as well. But so that's the US dollar index story. What's odd is that the US dollar index is rallying against currencies other than the Canadian dollar. So we also saw the Canadian dollar surge today back above 74 at certain points. When I pulled this chart, it was trading right around 74. So the other currencies in the basket, such as the euro and the British pound, Swiss franc, etc., are losing value versus the US dollar, not necessarily the Canadian dollar. So normally what we would see in a rising US dollar situation is Canadian dollar pulling back, which is generally positive to Canadian grain prices. But we're also seeing the loonie rally, and that may be putting a bit of a damper on some of the cash prices in Canada as well. All right, that is all we had for you today. Thank you for joining us. I know I talked really fast. Hopefully that resonated. And if not, feel free to listen to it again because I might do the same. Thanks for joining us. Have a great day, and we will see you again next week.